Have you ever looked at a stock chart that just shoots straight up and wondered, is this thing a rocket ship to the moon or a bubble that's about to pop? Well, today we're going to break down exactly that. We're decoding the story of a stock called ANRO and taking a deep dive into the technical signals that analysts use to make sense of this kind of beautiful chaos.
Okay, just look at this. Back in July, ANRO was just puttering along at $2.28. Fast forward to October 3rd, and it hit $6.89. That's a monster surge, and a huge chunk of it happened in a single explosive day. So what in the world is going on here?
Right, and that leads us to the big question, doesn't it? When you see a 200% gain in just a few months, you have to ask yourself, is this the real deal? Is this sustainable growth, or is this thing just running on fumes, getting ready to fall right back down to earth?
To answer that, we've got to go back to the day everything changed. Because this stock's wild ride, it all comes down to one single dramatic event, fueled by an absolutely unbelievable amount of trading activity.
I mean, the scale here is just insane. Over 61 million shares were bought and sold in one trading session. That's not a gradual climb. That's a tidal wave of money and interest that completely changed the game for this stock, literally overnight.
So when you see a move that massive, the first layer of analysis is pretty straightforward. You see a lot of green flags. Let's start with the bullish case, looking at all the technical indicators that are just screaming buy, buy, buy.
First up, and this is a classic, the stock's price is soaring way above its moving averages, which are really just the average price over different time periods. You can think of those averages as the stock's normal center of gravity. Right now, the price is like a rocket that is completely broken free, showing some incredible upward thrust.
And it's not just one signal. A whole bunch of different tools that measure momentum are all flashing green. You look at the MACD, the stochastic oscillator, they're all basically giving a big thumbs up, confirming that the buying pressure is super strong and consistent. From this angle, it looks like a perfect trend.
You know, this brings to mind that old Wall Street saying, the trend is your friend until it ends. And that word, until, is the most important part of that sentence. Because, as we're about to see, there's a whole other set of indicators telling a very different story.
All right, let's flip the coin and look at the other side of the argument. Now we're going to pivot to the warning signs, the little red flags suggesting that maybe this party is getting a little out of hand.
To get the bearish case, you first have to understand something called the Relative Strength Index, or RSI. The easiest way to think about it is like a speedometer for a stock's price. It tells you how fast it's been moving. And on this speedometer, anything above 70 is considered the red zone. The engine is running way too hot. Traders call this overbought.
So what's ANRO's reading on that speedometer right now? A jaw-dropping 82.78.
Yeah, a number that high isn't just a warning light on the dashboard. It's the alarm bells going off. It signals that the buying frenzy might have gone too far, too fast. It's a classic warning that the stock is overextended and could be due for a pullback, which is just a nice way of saying the price could drop so it can catch its breath.
And right here, this perfectly captures the analyst's dilemma. It's a classic tug of war. On one side, you've got the bull case, pure, powerful momentum. On the other, the bear case, all these signs of exhaustion screaming that the stock has been stretched way too thin. It's momentum versus exhaustion.
So, what do you do when you have powerful signals telling you two completely different things? Well, this is where analysts try to get a bit predictive. It's kind of like reading the tea leaves, but, with math.
One way they do this is by looking at the stock's own history. If you draw a best fit line through its past prices to see its normal path, that's basically what linear regression does. The current price is trading 56% above that trend line. That really puts into perspective just how extreme and unusual this recent move is. Next, they look at volatility, or how choppy the stock has been. For this, they use a tool called the average true range, or ATR. It simply measures how much a stock's price typically swings up or down in a single day. A higher ATR, which ANRO has right now, means you can expect bigger price swings.
So using that ATR measurement, we can actually project a potential price range for the next trading day. And it's wide. We could see the stock go as low as $6.35 or as high as $7.43. That just shows you how much uncertainty and energy is in this stock at the moment.
All right, so let's bring it all together for the final take. How do you weigh all this conflicting evidence, the incredible momentum versus the serious warnings, and come up with an actual game plan? Well, first, you map out the key battlegrounds. You establish the lines in the sand. The immediate ceiling, what traders call resistance, is that recent high of 689. The floor, or support, is the recent low of 476, with an even stronger safety net down at $4.07. These are the levels everyone's going to be watching. And with those levels in mind, you can lay out three possible scenarios. First, the bullish one. The stock smashes through that 689 resistance and just keeps climbing. Second, a neutral path. It just moves sideways for a bit, consolidating and catching its breath. And third, the bearish case. It pulls back toward the $6 range as traders decide to take their profits off the table.
So, what's the final verdict from the analysis? Well, it's nuanced, as it should be. The bottom line is this. The extreme volatility and those overbought signals mean you have to be cautious. A short-term pullback seems likely. But, and this is a really big but, the momentum is so incredibly strong that the bullish trend could very easily pick right back up after the stock takes a little breather. And that leaves us with the million-dollar question. Not just for this one stock, but for any situation like this, when the data is telling you that you're looking at both an unstoppable force and an imminent danger at the exact same time, how do you decide which one to listen to? Do you follow the trend, or do you heed the warning?